pain.
It could start tomorrow, or it could take another 2 or 3 years before that starts, but it's got to happen sometime.
It is something outside happening could puncture it here, and there would be very little you could do to prevent it.
I think if I'd known that the mortgage would actually have increased so much over the year, I don't think I would have actually taken the 100% mortgage out.
We talked to a few of the brokers, and it's just very difficult for them to give you anything that would actually buy you a house anywhere beside work or anything like that.
People only buy because they're confident about making that transaction. And if you have any shock to the system that actually causes people to postpone that decision, then demand slows down and house prices fall.
When you get a strong economy like we've had and very low interest rates, that's a deadly combination.
We have allowed building construction grow too rapidly and take up too big a share of the economy. We're out on a limb at this stage. Getting down off it is going to be delicate without hurting ourselves.
There have been 49 property booms throughout the world since World War II, and every one of them has ended badly. Badly, that is, for certain people, but not for everyone. What you're going to see tonight is just how vulnerable we are to a property crash in Ireland, and how that crash might happen. We're all familiar with the story of the boom in Irish property values over the past decade. Annual rises of 10, 15 and 17% started to seem normal. The collective value of property in 1996 stood at €91 billion. Today it stands at a stunning €516 billion. With that huge jump in value came massive borrowing, which has brought mortgage debt in Ireland to over €100 billion. A lot of people have done very well out of the boom in property prices. A minority have become billionaires. Others have made millions. People who bought their houses from the 1980s onwards found themselves in the middle of a huge economic boom, which provided them with a once-in-a-lifetime payout that they just weren't expecting. In urban areas like here in Ranelagh, people who bought as late as the late 80s and who had fairly standard careers as teachers and civil servants found themselves suddenly, as demand for property escalated, property millionaires.
The property itself is a 3-bedroom, 2 of which are en suite. Have I any advance on 900,000? 950. Thank you very much, madam. Is there 1 million? 1 million anywhere. Thank you very much. Do I have any advance on 150? 1-2 to the lady there at the back. Do I have any advance on 1-2? 1-250. 1-350. 1-4. 1-4. Going once? Going twice? No more bids anywhere? Sold. Thank you, madam.
And it wasn't just the urban classes who benefited. Land itself became a premium commodity.
The highest rate of increase was recorded in Kerry. Prices there rose by 15%.
In short, Ireland's property boom has created massive wealth. We're set to inherit €3 billion in property every year for the next 10 years. But over the past 6 months, a kind of paralysis has gripped the Irish property market. The phenomenal and seemingly unstoppable rise in house prices seems to have finally levelled off. The media are full of experts with conflicting messages about the health of the property market.
According to government revenue figures for the first 3 months of this year, the economy appears to be heading for a soft landing.
Making sense of this situation isn't easy for people who are concerned about their most valuable asset, their home. While financial factors help shape the market, there is something else at play. House prices aren't just driven by raw economics, but by human emotions, like confidence. Right now there are signs that confidence may be evaporating.
What's been driving the Irish housing market, particularly over the last few years, has been expectations or sentiment. After all, we've seen interest rate increases in 2006, yet house prices rose by about 12%. How can one justify a big increase in house prices in an environment where interest rates are increasing. It's got to be sentiment. And once sentiment changes, it tends to go downhill very quickly.
What happens is people are happy. House prices aren't rising. They buy them when they need them or when they can afford them. However, if house prices start falling, and you can't see any reason why this, because there's a world recession on, people are losing their jobs, they feel, if I go out and buy a house, I could be lumbered with a house and a mortgage and couldn't afford to pay it. So I said, I'm going to wait until I'm certain about my job. If everybody holds back and waits, no houses are sold. What happens then? House prices fall.
Banks and lenders reassure us that if house prices do fall, we can expect a soft landing.
There have been statistics produced by various bodies, including the OECD, to show that housing booms are frequently followed by crashes. But I would have a view which is shared with many of my colleagues, which is that the most likely scenario for the Irish one is a soft landing. Now, why should that be? It's because of the fundamental factors in the Irish economy. It's because of the affordability, because of first-time buyers. But of course, there are people who are not first-time buyers, and many of them are in extremely favourable situations.
What you tend to get is, in periods of stagnation in property markets, prices just go nowhere for quite some time, or they grow at a very slow rate, and incomes catch up and rents catch up, and that corrects any excesses that may have been in the market. So it's hard to see prices falling, and certainly hard to see them falling significantly. But there could be a period of stagnant house prices, just like you saw an incredibly strong period of house price growth for a decade.
However, others tell a different story.
You don't get falls of 5 or 6%. Either you get a stabilisation or you get a big fall.
Remember, housing market is an asset market, and asset markets, be it stocks or bonds or houses, are very volatile, and they don't get nice, smooth adjustments. I could name you 30, maybe 40 hard landings after studying booms and busts in other countries. I cannot name you one instant of a soft landing. Housing markets just don't work that way. It's just very, very difficult to pull off a soft landing.
If the property market does fall, how bad is it going to be? Will we drop by 50% like Holland in the 80s? Or 46% like the Finns? Or 34% like the UK in the 1990s? And if the pessimists are right, will everyone share the financial pain and carry the consequences of negative equity into their future? What will the legacy be for a new generation that bought into the idea of owning their own home? But more importantly, how would it happen? There are three major threats to the Irish property market. Threats that seem like abstract economic concepts, but each one of them has a direct impact on the safety of our homes. Ireland is now one of the most open economies in the world. People, money and goods pass through our island as global trade roars on. Being connected to a bigger world means that the cause of any future property crash is as likely to lie outside Ireland as inside of it. On the 1st of January 1999, 11 countries in the Eurozone, including Ireland, adopted the euro. The euro promised us low inflation and low interest rates. The trade-off, we would no longer be able to control our own interest rates to stem rising house prices. Our inability to control interest rates has driven the serious rise in Irish house prices.
Once the European Central Bank came into existence, for the first couple of years, interest rates were at more normal levels at around 4 to 5%, but then they fell dramatically down to 2%. So interest rates here were a lot lower than they would have been had we had control of them ourselves. There's no doubt about that.
In Ireland, lower interest rates gave the Irish property market an unforeseen second life. As prices began to really take off in the late 90s, the government got economic consultant Peter Bacon to do 3 reports on how spiralling house prices could be tackled. Bacon made a series of recommendations, the key one of which was reducing the tax relief for those investors who were buying multiple properties and whose active investing was putting first-time buyers under pressure. In 2001, Charlie McCreevy introduced this measure and prices cooled off to such an extent that the government became nervous and reversed the measure. The market took off again. Between 2002 and 2005, property prices rose by 45%. Interest rates are now definitely in an upward cycle, putting pressure on households throughout Ireland, with 6 rises over the last year.
We reckon it's taken about 1.5 billion out of people's pockets now. That's quite a sizable figure. The risk is, given that growth is so strong in Europe at the moment, rates could go maybe as high as 4.25%, 4.5%.
Some experts are even predicting that interest rates could reach 5%. Those kinds of rises would have huge impacts on mortgage repayments and would compromise the group who are the most vulnerable in any property market, the first-time buyer. First-time buyers are particularly important to the health of the property market. They borrowed a whopping €8.4 billion in 2006, and it's their purchasing of houses that maintains value in the market. When they stop buying, prices begin to deflate. So if first-time buyers have to borrow heavily to get on the ladder and carry debt for the next 3 or 4 decades, what kind of legacy will the property boom have left to the generations to come?
First-time buyers probably have the most significant effect on the market, because if we see any significant reduction in the number of first-time buyers coming through, then there's a ripple effect, and the number of potential investors, people who are going to trade up in 4 or 5 years, will eventually ease off as well.
Trainee nurses Sarah and Barry are getting married next year and would like to buy a home, but aren't feeling too confident about getting a foot on the property ladder, even though in 3 months' time they will both be fully qualified and earning full salaries.
We're renting at the minute. We've been renting for about 2 years now. And we talked to a few of the brokers and stuff like that, and it's just very difficult for them to give you anything that would actually buy you a house anywhere beside work or anything like that. We friends of ours, like, rushing to get a mortgage, and they get a mortgage, and you say, how much are you paying? Oh, €1,700 a month, and you're like, that's your whole salary, you know. And I don't know really where you're meant to start. There seems to be nothing there. Like, people just seem to plod through it and hope for the best, don't they?
Yeah.
The average price of a house in Dublin is now €420,000. With a salary of just under $29,000 each, Barry and Sarah are seeking the help of independent mortgage broker Pádraig O'Mahony.
Okay, Barry, Sarah, will you give me a salary, basic salary of 28,878. So if we look at the quotes, we're looking from anything from 255,000 up to 378,000.
Right.
Now it's getting closer, but again, even 378,000, if you take 420 as your purchase price, minus 378, that's 42 grand that you need to have in savings. If you look at the average monthly repayment on those mortgages, you're talking about €1,724 per month. Now, after tax relief, you're talking about a figure of $1,591.
Right.
An increase of about 0.25% in the European Central Bank rate is going to increase your mortgage every month by about €100 to €110 per month. Again, increase of another 0.25% towards the end of the year, you're talking about another 110 per month. You know? That down on top, as I said, of gas, electricity, you name it.
Everything. The price of fitting out a new house.
Yeah.
Do you know,
absolutely.
Everything that goes with it.
Yeah. Unfortunately, you're stuck with payments, as I said, about 1,700, and
for 35, 40
absolutely.
years. That's absolutely crazy. How does anybody get onto a property ladder at that rate? Do you know? How can anybody have any life?
I don't think
does everybody stay inside all the time? Right, so I'd have a double JD, please.
Are first-time buyers being put in a position where they have to borrow more than they can afford? In the near future, it might be a case that the only way for first-time buyers to get into the market is for prices to drop.
From any mortgage provider's perspective, the last thing that they want is customers that are overexposed. An overexposed customer potentially would lead to arrears and is more detrimental to the economy, to customers and to mortgage providers than anything else. So our objective in life is to make sure that any customers we're lending to, it's easily within their grasp to make those repayments.
The first-time buyers most exposed to rising interest rates are those who bought since early 2006 and have little equity in their properties. For them, a market slide could have serious long-term implications. But even now, there are first-time buyers that have managed to get on the property ladder and are finding themselves locked into mortgages that are hemorrhaging their incomes.
This apartment was 315,000. I bid on 5 places before this and got outbid every time. I didn't really have a choice of going for a 2-bed because the 2 beds were so much more expensive, which obviously would have been better for me because then I could have rented out the extra room with the increase in interest rates. I wasn't aware that the interest rates could go up 4 times within the year, and I hadn't been warned of that. I think if I'd known, I don't think I would have actually taken the 100% mortgage out. I think I would have actually re-looked at it and held out, or possibly, if I really wanted to, I would have bought an investment property further out of town and continued renting. And I am trapped to some extent because if I rented out this apartment, I wouldn't get over €1,600 rent. So I do feel slightly trapped. However, I am happy in the apartment, so I'm happy enough to try and keep up the payments for the moment.
For people like Rachel, a dip in house prices could leave her trapped in her present property for some time to come. What could place someone like Rachel in profound difficulty would be a downturn in the Irish employment situation. 2006 saw the highest number of people employed in the state's history. But when you look beyond the hype of high employment figures, a different story begins to emerge. The health of one sector is critical to the economy. The construction industry directly employs 280,000 people, making a quarter of all economic activity in Ireland construction-related.
Building construction in a normal economy would be about 1/8 of the economy. In Ireland, it's double that. It's 1/4 of the economy.
In 2006, we built over 93,000 new houses. Nobody thinks we will still keep building at the rate we are now. According to economic consultants DKM, 2007 will be the first time in over a decade we could see a significant slowdown in house building.
Housing supply has probably peaked in 2006 at around 88,000. It'll be close to that level in 2007, and we would expect that the housing supply will fall back over the next number of years. With house prices running at 15% per annum and building at peak levels, I mean, we're building at the highest rate in Europe. We build about 20 units per 1,000 of the population. The UK has 10 times our population. They build 5 units per 1,000 of the population. So we're far from equilibrium at the moment.
With construction contributing 25% of economic activity, if jobs were lost in construction, it could cost the economy billions, leading to a knock-on of further job losses in related industries which have grown as a result of this housing boom.
You've had a shuffle of people and resources from the exporting, the tradable sector into building construction. The problem is, will those jobs we have destroyed be recreated quickly? And I think they won't. If unemployment begins to rise and you create uncertainty, then you could have a dramatic effect because people stop buying houses. And you could then, because the building construction sector is such a big part of the economy, if that slows down dramatically, you could see a snowball effect, which could be very unpleasant.
If these jobs are shed in the near future, then so will people's ability to pay their mortgages, which could hit the property market hard. This could also depress the rental market, with investors searching for tenants to cover their new mortgages. Out of the 280,000 people employed in construction, 30% are foreign nationals who are unlikely to stay when construction takes a downturn.
I left the wife with the small child. My father left the wife and my sister. These lads left the wives and the small children as well. That's all we left the families in Poland. Most of these lads living with me. We all renting the apartments or houses. I am here almost 3 years, and my father is here 6 months already, and we want to stay here longer because the money is much, much better, and the situation from the life here is much easy. How long we have the job here and good conditions, we stay here. I tell you that thing, if the start to be problem with the job here from all foreigners, they just going back to countries, that's it.
If there is an exodus from Ireland of foreign construction workers, the properties they currently rent would come back on the market, putting investors under pressure with rising interest rates. Some landlords may decide to sell.
Because of the property market boom and the big increase in construction activity, we now think, or at least some people do, that we can grow quickly based on construction and we no longer need our exports. And that, I think, is a very dangerous idea.
In step 2 of So You Want to be Taoiseach, Ardal O'Hanlon takes us through becoming a minister. So You Want to be Taoiseach, Thursday at 10:15 on RTE1.
Ireland's economic reliance on construction may turn out to be a very short gain, and ironically could undermine the very market it's fueling. However, the over-reliance on construction is not the only threat facing the Irish property market. Another key factor in Ireland's success story has been our ability to manufacture and export goods at competitive prices. But other countries are catching up. And if you think that's worrying, something much more worrying is on the horizon.
Our mission, as set forth by the Congress, is a critical one: to preserve price stability, to foster maximum sustainable growth in output and employment, and to promote a stable and efficient financial system that serves all Americans well and fairly.
Investment in Ireland by the United States of America has been crucial here. 25% of our exports go to America, and our economic health, like many other countries, is heavily bound up with the future of the American economy. But a look at the overall balance sheet would have anyone worried.
The United States has a record-large trade deficit. It imports a lot more than it exports. That's an unsustainable position.
That trade deficit is killing American jobs, and the American government has to act soon. Most economists agree that the solution is to let the value of the dollar slide. By devaluing the dollar, America will make exports cheaper. But what's good for America may not necessarily be good for Ireland. A devaluation of the dollar is the sort of external shock that could lead to a serious property crash.
This is a trading economy. Imports plus exports are well over 100% of GNP. And therefore, the ability of Irish producers of goods and services to sell overseas is critically affected by the exchange rate. If the dollar were to drift down to 150, that would be a very serious negative factor for economic growth and output per head year. In fact, I think it would provoke a serious recession.
If plummeting profits and inevitable job losses in small Irish manufacturing companies could be the result of a sliding dollar, how would devaluation affect the multinational companies who've located in Ireland, taking advantage of benign tax rates and an educated workforce?
Some international economists are indicating that the dollar could depreciate to 150 compared to 130 at the moment. That's about a 15%. So putting that in practical terms, it means that our cost base here goes up 15% in the eyes of our parent company, and we've added no extra value in that context. So if that was to happen, we would become more uncompetitive again relative to the other European countries and the other lower cost countries.
I think there should be some kind of concern, absolutely, because we haven't had a significant foreign direct investment here in over 15 years. We've seen the drift abroad of these manufacturing jobs. We're competing with very low-cost economies around the world, and the most expensive thing that companies have these days is the cost of labour.
One of the key reasons that salaries here are so high is that people have to pay higher mortgages. If the cost of labour puts the future of our multinationals at risk, how does the labour force in these companies feel about the future, about the stability of their jobs and their homes?
Overall, are you fairly positive about things? The economy, jobs, property?
I think the biggest concern there would be if a large business were to move in the short term, it's the knock-on effect that that's going to have in those particular areas of the city. And there are areas of the city that have been referred to as, potential ghettos should that occur. And I think what you need is a balance and an even turnover.
The amount of property, both owned and rented property, that is totally dependent upon Dell and all the other companies that are tied into Dell. I mean, it's a significant risk. To say for every one direct job in Dell, there's probably 2.5 indirect. So there's a high dependency. And if anything were to happen at multinational, it'd be devastating to the companies,
I think the property boom and the construction boom has disguised a lot of the loss of competitiveness that we've experienced over the last few years.
Toy and game manufacturer Hasbro said it was laying off 140 workers at its factory in Waterford City over competition from China.
The plant is almost certainly gone now, with the loss of around 350 jobs.
This month, US company Client Logic said it was laying off 138 people.
This isn't low-end manufacturing. These are the cream of technology jobs in this country.
French company FCI Ireland said it was moving its precision electrical connector business because of high costs here.
The latest cuts will apply to all administrative departments and organisational levels at the Limerick operation.
In relation to Pfizer, I understand that 65 people are to be made redundant and that 2 plants are to be sold as going concerns.
So the jobs are gone. Pfizer workers are reeling tonight after they were told 545 jobs are under threat.
I'm in the early stages of a 25-year mortgage, 3 or 4 years into that, 2 small children, a wife at home.
So when it comes to interest rates, jobs and even America, we may be vulnerable to a downturn. But are there already cracks appearing in the Irish property market? The warning signs have been continuously coming from many quarters over the past 2 years. The IMF, the OECD, the central bank, they've all warned about overheating in the property market. Some commentators have said house price growth would be 3% in 2007. However, what this disguises is that house prices in some parts of the country have been falling since last November, with price falls of almost 14% already happening in certain areas. Here in Clonee, for example, the asking price of houses actually fell by over 8% in the second half of 2006. Why would that have been?
I think really it is a question of interest rates is why this is happening. You know, people are going to banks, they're not being lent as much, and they're going, well, hang on a second, I can't actually afford that property, or I don't want to commit myself to that monthly repayments. I look for a cheaper house in a nearby area. And that's really the Clonee story. And you're going to see that mirrored in many locations across Ireland over the next few months.
There is a growing overhang of new houses for young families, particularly around Dublin, out beyond the M50. And those are the areas where you're likely to see big problems in terms of people with very high mortgages finding that the house they bought isn't appreciating at the rate which they expect to be bought.
If you're living in an area that demands a premium price, you have to identify those premium factors. You know, is there extra better schools? Is there better transport? Is it very close to the city centre? Does it have a better quality of life? And then you need to look at the rents in those areas and say, are the rental yields good? Now, if you live in an area where you can't identify those premiums and the rental yields are poor, yet the prices are high, that is the place that is most at risk for a price drop in the coming years.
For the first time in 5 years, there is an oversupply of property in the middle and upper end of the market. Anecdotal evidence suggests the price of some properties in South Dublin has started to slide.
Certainly the level of panic in the market that might have been there about 12 months ago, particularly at the upper end of the market, that fizz, and I describe it as an artificial fizz in the marketplace, is now really gone.
The ESRI Permanent TSB House Price Index shows a market that has ground to a halt, with a growth of 0.1% over the last few months. Over 80% of the houses that went to auction in the Dublin area at the end of last year were withdrawn. Significantly, the big lenders themselves are starting to cash out of the property market here. In April of 2006, AIB sold the Bank Centre property in Ballsbridge in Dublin to developer Sean Dunn. Bank of Ireland launched a marketing campaign in September for the sale and leaseback of 36 of its branches in Dublin and other cities and towns. Also of note, big estate agents are selling out. Last year, HOK sold their business to Savills, and Guns sold their business to outside investors. One has to ask the question, if the banks and estate agents are cashing in, how do they see the future of the Irish property market? The cracks are definitely appearing after a period of unimagined growth, but are we all still in collective denial? If we were in trouble, would estate agents, banks and government be sending out dire warnings? Is a property bubble not an obvious thing? To try and understand that question, we need to go back almost 2 decades to a series of events that a lot of Irish emigrants were caught up in. London, in the 1980s. London in the 80s was iconic of the new individualism spawned by Margaret Thatcher's remaking of Great Britain. Everything that could be was deregulated, including the mortgage lending market itself. The prevailing mood in Britain was borrow as much as you can, because if you don't get on the property ladder today, you'll be locked out forever.
There is no prouder word in our history than freeholder.
She said that this is the way to make Conservatives, is to have people with a stake in the country, and the stake is their house.
Boom fever gripped the nation. House buying had become a speculative game, with all the players guaranteed a win and tax relief as well. By the end of 1988, house price inflation had reached its highest rate of 34%. Then it flattened out, and in 1990, the unthinkable, the fall, began. Home buyers who'd taken out huge loans to buy houses at peak prices found when they fell that their house was worth less than their mortgage. Negative equity had arrived.
I think at the time, like many booms, people didn't think it was going to happen. I don't recall people saying, prices are going to collapse, because market confidence is such that even if people thought that, they wouldn't say it, because they have vested interest in hoping that the market will keep booming. Conversations in the pubs and the restaurants, it's all about house price booms and about gazumping and about making money out of housing. There was certainly that kind of climate around.
Because you had more disposable income, you didn't question that it was going to stop. There was no reason to, because apart from anything else, you trusted the banks.
Banks and new institutions coming into the mortgage market were competing for borrowers, so they were throwing money at people, really, encouraging them to borrow more and more money for more and more expensive properties. So the government was concerned that, in a more competitive, European context, the economy had to be brought under control. So what went wrong was that interest rates went up by 50%, and people couldn't afford to pay their mortgage.
From May 1988 to their peak in 1990, interest rates shot up dramatically. This steep rise had a devastating effect on household budgets, as evidenced by escalating arrears and repossessions.
The government has asked building societies to come up with proposals to try to halt the number of homes being repossessed.
Until a few weeks ago, this was a family home. Now it's empty, awaiting sale. One of around 80,000 homes repossessed by lenders this year. The family are living in a costly bed and breakfast hotel. Robin Evans fell behind with his mortgage after his business customers were late paying their bills. It's devastated the family.
This used to be Mike and Sue Richards' home.
Are you still feeling already humiliated? There'd be something wrong if you didn't. You don't expect things to happen to you. It's something you read. You don't expect your house you worked hard for to be repossessed. I feel embarrassed. I feel very embarrassed.
My analogy is not that it's a prison. I see it more like the Titanic. We thought it'd never sink. And I think, we're suddenly looking for the life rafts.
By the time interest rates began to fall, recession had already taken hold, and unemployment was on the rise. Business confidence was taking a nosedive.
Initially, the impact was on, I would say, surprisingly, more affluent households. Around about 1992, one of the building societies published a report showing that 40% of the repossessions of properties were houses owned by professional households, architects, doctors, lawyers, which was very surprising, actually.
We were all up in London, I think was it called Black Wednesday, when the rates went up something like 15%. That was the start of the end. We were sort of like a bit on a roller coaster, thinking, this will stop, it'll revert back. And not that our spending was outlandish or anything, but we did have this very lovely home. Anyway, the bank foreclosed on what was owing on the house. Michael took it very, very badly. I mean, the house was his life.
Marion, Michael and their daughters packed up and left their family home. They moved to a small rental accommodation in one of the country's sprawling new estates.
So we moved in there on the 1st of April, and on the 5th of May he was in the morgue. And it was brain tumour, which they directly attributed to stress. He was obviously keeping a lot more to himself than I was aware of to do with this, and so it was building up, but he just went so quickly.
Between 1990 and 1995, some 350,000 properties were repossessed. By 1993, it was estimated 1.7 million British people were victims of negative equity to the tune of £10.8 billion sterling.
At the time, there was this kind of frenzy that people thought that prices wouldn't go down because if you look at the history of booms, that's what people believe. It's against all expectations, and optimism triumphs over past experience. So although prices went up, I think 16% and 18% and 23%, I think in '88, people still thought they were going to keep carrying on.
The economists, the journalists, the bankers, the government, nobody predicted it or saw it coming. Are we in Ireland in a similar state of denial? Many individuals, families and investors' futures are significantly tied up with the health of the property market. What if the market did crash here? What would it look like? What might trigger it?
Let's all look professional. Perfect. He'll be here in 2 minutes. Ah, Chris! Good to meet you, Chris. Thanks for coming in.
Hello.
No, Mr. Henderson.
Chris?
No. TV licence inspector.
Very professional.
Is there any recourse at this stage?
Cabinet has approved tough new measures.
It's not definite that we will see a serious property crash in Ireland, but if it were to happen, this is what it might look like. We've already seen the dollar slide against the euro. That slide continues. By the end of 2007, it falls in value from 131 to 150 to the euro. In Ireland, we are not immune. Irish exporters start to get worried because they find the goods they want to ship are not selling as well outside the EU because they're now dearer to buy. It slows things down. Confidence begins to suffer. In the US, house prices fall further as Americans tighten their belts. Ben Bernanke, the head of the US Federal Reserve, shows no sign of intervening to boost the value of the currency. The market believes it can only fall further. In Ireland, US multinationals don't meet their profit targets. Jobs that are here look safe for now, but there aren't new jobs coming. By the spring of 2008, the dollar falls further to 170 against the euro, its lowest level since the early 1980s. Some American multinationals look to switch projects out of Ireland to cheaper locations. It's not a disaster, but the trickle of job losses dents confidence. At the same time as the dollar falls, house building slows down. After building over 80,000 houses per year for several years, supply meets demand. New house building slows to 60,000 homes being built per year. The slowdown puts pressure on construction jobs. Some builders find work as the government continues to spend heavily on new infrastructure. But it isn't enough to sustain the 400,000 people directly or indirectly employed in construction. By early 2009, unemployment has doubled from 4% to 8% as 100,000 jobs are lost. The impact of this on the property market is dramatic. Around 40% of all homes built in Ireland in the last decade were bought by investors who've rented them out. These investors have begun to get nervous watching events unfold. The inflow of foreign workers has slowed down. Many foreign workers, lured here by jobs in construction, restaurants and hotels, begin to leave as the work dries up. It started as a trickle of properties coming on the market in 2007. It turns into a flood as investors who bought properties in 2006 at premium prices start to panic. The initial fall in property prices gets worse as more houses come on the market. The 8% fall of 2008 falls to another 18% by the first half of 2009.
Interest rates across the Eurozone are likely to rise again next month, and further increases are on the cards, a leading bank official has hinted, as interest rates here in Ireland have reached 5%.
The banks get worried that they're overexposed to property. They tighten up their credit for house purchases. This makes the situation even worse. First-time buyers find they can't borrow nearly as much as they could before. The oversupply of houses being sold by investors and the tightening up on lending by banks drives prices down.
Homeowners in parts of the Dublin commuter belt have now reached negative equity, according to the authors of a new report.
Some areas are worse hit than others. Apartments pitched at getting people on the property ladder are worst hit. On average, house prices by the end of 2009 have tumbled by 30% cumulatively. With house prices down, those looking to get into the market should be in a better position. But the banks have tightened on lending, so it's still hard to get on the property ladder. Confidence has been hit. As confidence falls, people stop spending. They now see their credit card debt as a real problem. As they stop spending, economic growth slows down. So if property prices were to fall by 30% nationally, what situations might people find themselves in? The typical couple who bought their first small apartment in the centre of Dublin in 2007, just before the crash, for €350,000, find it's now worth €297,500. They want to sell it so they can move on and buy a house more suitable for bringing up a family. But if they sell, they will lose €52,500. To buy the house they want, they need to be able to carry that loss. The bank won't give them that much money, and they're stuck. They just assumed they would make money selling on their first property. The young family with 2 children who bought a house in the commuter belt for €450,000 find its value has fallen to €292,500. In what is becoming increasingly common throughout Ireland, multinationals continue to cut back on the workforce. The husband loses his job. They struggle to meet the monthly mortgage payments.
In a new report today from the Central Statistics Office, the number of properties repossessed by lenders has continued to rise sharply, up 9% in the second half of 2008.
The investor who arrived into the property market in Athlone not long before the crash has 4 houses on interest-only mortgages rented out to foreign construction workers. The construction workers move on as the sector slows. He paid €400,000 for each house, and that is what he still owes on each one. They're now worth €280,000 each, a fall of 30%. If he sells all his properties, he will still owe the bank a total of €480,000. The single woman who bought a 1-bedroom apartment in Cork for €330,000 is also finding it tough. This apartment, like thousands of others, has been very badly hit. If she sells it, she will only get €247,500 for it, a loss of €82,500. She has a chance to move to a better job in Cavan Town. Property is cheaper there, but she can't carry the loss and still finance the purchase of a new home. Not everybody has been badly hit. Those who bought their homes or investment properties back in the 1990s have done well. The worst affected are those who bought their first homes or investment properties just before the crash. It's a mixed bag. For some, the situation is very serious. For others, it means they cannot make the choices they want and find themselves stuck. It may be several years before property prices return to levels which would enable them to get out of their predicament. In the end, it is the householder that is left with the legacy of a market that boomed and then crashed. So if that is what a crash looks like, is it fiction or could it be our future?
In 1996, we saw growth rates approaching 25 to 30%. We don't expect those days to return because we think the exuberance of those years are well and truly over. However, we're moving now into a more stable, robust period of growth. And certainly over the next 6 to 7 years, we're looking at mid-single figures, mid-digit, probably about 5 to 6% on an annual basis.
Well, typically, if you look at other countries that have had booms and busts, house prices give up about 1/3 of their value from their peak levels. So if we had a typical house price bust, and these busts are very common, these are in no sense rare, then we could expect Irish house prices to fall by 1/3. That would not be unusual.
How worried we should be will depend upon what happens to the house building sector. If we get a smooth, soft landing and a smooth slowdown and housing output falls slowly back towards more normal levels, then I think the economy can cope with that. But if you have any exogenous shock to the system, which would cause the housing market to slow much faster than we might expect, then you have a problem.
If I was certain that the market was going to collapse tomorrow, I should sell my house and rent it back, and I'm not doing that. So I'm risk averse. So I don't think you've got to look at each individual and their circumstances, and to say, give up now, I think, is wrong. To say, buy now, is wrong. Look at each individual. But as an economy, we need to slow things down, and that's where government needs to take action.
My instinct is to say that government policy over the last 10 years has been an unmitigated failure in the sense that they kept on intervening in the market, discovering that the law of unintended effects rose to bite them in the bum, and then changing what they did. And I think there were 4 Bacon reports over a period of 6 or 7 years advising that they do this or they do that or do the other. And in each case, what happened was that the government introduced piecemeal various changes. And every time something went wrong, they're not good at doing this. And that's a fact of life, and that's why I believe you inform people as well as possible, and you let them take their chances.
We've come through one of the biggest property booms in post-war Europe. That boom is now over. For some, it created unprecedented wealth. For others, it now creates unprecedented risk. These are uncharted waters, and we're in for a bumpy ride.
Next Monday at this time, a new series uncovers the powerful human stories at the cutting edge of Irish medicine. A flavour of what's to come is on the way.